Experian Consumer Default Index has been warning for months of the impending consumer financial distress. The organization now says the fact that South Africa's major banks have recently upped bad debt provisions is an indication of just how much of an impact interest rate hikes have been on all consumers, and in particular homeowners. Jaco van Jaarsveldt is Experian Africa's head of commercial strategy and innovation, and he joins us now. Jaco, thank you very much for your time this evening. Jaco, please unpack for us the latest findings of the Experian CDI report.
Yes, thank you for having me again, Xolani. The Experian Consumer Default Index basically is an early indicator or a lead indicator for consumer distress in the market, as we've shared with you before. It's a very important indicator in that it looks at consumer distress in advance of the consumer actually defaulting or a bigger trend in default in the South African market. So when we look at the trend over the last 12 to 15 months, we've actually observed that when at the onset of interest rate increases, there was a distinct deterioration in specifically the top end of the market, which was pretty unique compared to previous financial distress that was experienced during the 2008 financial distress or market crash, where the top end of the market was effectively immune, or a large portion of that market remained immune to the distress that occurred in the economy. Whereas this time around, we early on started noticing that the top end of the market, which predominantly is the section of the market that's exposed to secured lending products. And it's important to note that when you consider that we've got roughly 2.1 trillion rand of outstanding debt in South Africa across the South African consumer or credit active consumer base, 1.6 trillion of that is allocated in the home loans and the vehicle loans segments of the market or verticals in the market. And that is where we observe the distress. And when you dig a bit deeper and you go, well, if the distress is observed there, which segment of the market is it that is distressed? We very clearly realize that there's a segment of the market that's been exposed to home loans and vehicle loans, and specifically home loans, for the first time, that has never ever been exposed to high interest rates. And as interest rates started increasing, and to the extent that it's increased now, is where we see the significant distress at the top end of the markets and specifically exposed to secured lending.
Jaco, in your opinion, what are the factors that are highly contributing to consumers remaining with bad debt? Because we're talking about bad debt in particular, because there is good debt and there is bad debt.
Yeah, so if you think about bad debt particular, no consumer out there intends not to pay their outstanding debt, specifically when it comes to your house and your car. And what's causing this, Xolani, it is really the exposure and the first-time exposure to very high interest rates and the high inflationary environment. So cost of living has gone up. Interest rates have gone up. The electricity cost has gone up. So that distress that is now translating into consumers struggling to make those payments on these secured lending products, and specifically home loans, is what we started observing 12 months ago. And specifically, as I mentioned again, it is the more affluent segment of the market that is experiencing this distress. And what was concerning when we started seeing this trend occurring was that the rate of first payment default, and that's an important measure, the first time ever that consumers in that segment defaulted, started increasing more dramatically, specifically in the home loans environment and then in the top end of the market. So one should be careful in calling it bad debt. It's not bad debt. It's clearly the distress that consumers are facing, and it's very difficult for them to stay ahead with the payments required across their different credit products, specifically the bigger credit products, which is home loans and vehicle finance.
So, Jaco, how can consumers cope with the increasing interest rate, and what options are available to them?
The most important thing when we get to environments like this, where it's your primary or your primary or your big debt, the house over the house that you own, that is under distress. The strongest word of advice to consumers is do not wait for it to get too big of a problem. if you think about it logically, if you miss one installment on a home loan or two installments on a home loan, it's virtually impossible to make up that arrears due to the magnitude of that payment. And therefore, when you start experiencing this distress as a consumer, reach out to the bank. The bank has no intention of repossessing your property because it makes no commercial sense for them to repossess the property. They would far rather have the conversation with you as a consumer and have a conversation in terms of repayment plans or amending repayment plans to ensure that you remain in the property and they at least get a portion of the loan paid back, as opposed to you not paying at all and avoiding that conversation with the bank. So specifically in an environment where when we start talking about homes and vehicles, that's fundamentally critical to wealth creation for all consumers. Rather reach out to the bank and ensure that that conversation takes place to not get to a position where it's beyond recovery, that installment is significantly greater than you're able to repay or to recover from.
Jaco, why do you think the banks are increasing bad debt provisions and now? Is it because you think that they could have or should have seen it coming, that the high interest rate environment and the tightening environment of the SARB would get consumers to this position where they are at right now?
Yes, Xolani, that's a very good question. The challenge that the banks faced, and this is where it becomes a bit technical, if one thinks of the top end of the market that's exposed to these products, post-COVID, we saw that the banks focused on lending to existing customers as opposed to taking on new customers. And that focus on existing customers came in the form of extending additional facilities on home loans and extending additional and vehicle loans, right? Because it's easier for a bank or a financial institution to lend to someone that they know. So I've got a proven track record and thus I lend to you. What happened in this specific segment of the market that's exposed to high interest rates for the first time? And we're talking about age groups between first-time buyers up until in their upper 30s that's not experienced high interest rates. That segment of the market, the interest rates started detrimentally impacting on them. But if you look at it from a technical bureau score perspective, now the bureau scores that metric. It's a big component of your credit passport as an individual. That metric is an indicator of whether you're in distress or not. Now, when you look at a home loan, and the rate and the pace at which that bureau score would start showing the distress, it's delayed relative to distress that's observed in a short-term credit product where you immediately see it when that first payment is missed. Because on a home loan, people would draw down on available facilities. Plus their scores and the status of a consumer that gets access to a home loan, they have a relatively high bureau score. And an Experian bureau score that's high gets you access to other financial products easily because that passport measure is used in assessing you for credit. And thus, that score takes time to deteriorate. You first have to miss payments. And what happened and what we saw was other factors that started showing that people are in distress, starting to draw down on home loan facilities without missing payments, starting to take out unsecured short-term loans without missing payments. And those are the indicators that started flashing red lights to us to say, hold on a second, whilst the score remains constant, the available funding is people are becoming under pressure from limited available funds, and they're now leaning on short-term credit or loans to fund it. And ultimately, as we all know, you can only go so far. You've only got so much money. You've got more loans, and now people start defaulting. So whilst one can say that, yes, we should be aware more, what we should say is that the traditional means in assessing credit has actually diverted from the traditional mean into a different mechanism where you need to look at who is the consumer, which segment are they in, what is their behavioral patterns behind using other credit facilities, as opposed to only looking at the score. Because a score of, let's say, example, 700, there's good 700s and there's distressed 700s. And what we need to do as a marketplace today, specifically where we are, we need to consider different metrics and other mechanisms to further segment people within a certain risk category.
Jaco, thank you very much for your time there. Jaco van Jaarsveldt is the head at Experian Afrika, the head of innovation at Experian Afrika, talking to us there about how the high cost of living is leaving a lot of consumers in financial distress, particularly in this time around, at least in the past 12 months, the middle and upper middle class categories are also in for some tough time.